Hello everyone. In this lecture we're going to be discussing about revenue analysis. What do we mean by revenue? Well, simply revenue are economic resources which a company earn during a time frame. Okay, so you may think about quarterly results or yearly results companies announce on a regular basis. So when they announce the results, what is the revenue the firm has generated in that time frame. Okay, so we're going to be analyzing the firms for their revenues. All right, now when we do financial analysis or financial statement analysis more precisely, idea is to look for the yearly reports and as well as the quarterly results. That will give you a fairly good idea about a company. So what essentially is about the revenue? So two criteria. First one is the company has provided goods and services. So that's the first criteria um, for assessing whether the revenue has been occurred or likely to be occurred. Okay. The second criteria is that the company has collected the cash or not towards the goods or services it has provided. So if the two criteria are fulfilled, then we can say the revenue is realized. All right. Now, however, while analyzing or looking at the financial reports of a company, we we certainly face different kinds of challenges. You can get the numbers from their annual report or um, quarterly reports, and you can do a bunch of calculations on your end, like say you can calculate different ratios, you can calculate the pattern of revenues, so that's fine. But when we do analysis, the idea is to get deeper um, into it, or in other words, try to understand the hidden meaning behind the numbers, right? So we face certain kind of challenges. So what are those challenges? Let's talk about first challenges. The customer pay in advance. So many businesses, many companies, or many services, their customers, they pay in advance. For example, the airline industry, you book ticket in advance. So customer has paid, okay, in advance for the future services. Now, as an airline company, airline company has to provide services to the customers. Otherwise, if they do not provide at a certain date, there might be other expenses. Let's say have to return back money to customers with penalty and so on. So that's definitely a challenge. However, as soon as customer paid in advance, so that money will be reflected in the balance sheet. Okay, or it's say for example, customer booked a ticket for the next quarter flight, but the revenue is realized in this quarter. Okay, so that revenue would be there on the financial reports for this quarter. But what happens if tomorrow company doesn't provide services? They will have to pay back the money as well as interest charges and the penalty charges. So need to be very careful. So certain questions one can ask with the management or to themselves while reading their annual reports or analyzing the results. Are the costs estimate comparable to previous years? That, for example, how many customers paid in advance and how much company had to return back and what's on, or you know another question one can raise, that how accurate are the cost estimates? Because let's say there are some estimates, company has put, okay, we did this estimate, but what is the accuracy of those estimates compared to previous year and previous year? So, you can get a pattern based on past years, or if you are doing on quarterly basis, so let's say first quarter of 2016, then you should be checking the same quarter, first quarter of 2015, how the company did. Okay, that way. How the firm estimates compare to other firms in the same sector. For example, you plan to take a flight via Air Canada, okay, and there are two major carriers in Canada, WestJet and Air Canada. So how these two, how if you are analyzing, say for example, uh, for Air Canada, then you should be looking at how the WestJet is doing, okay, or because both companies have the similar business model, the customers pay them in advance and they for the future services. So some sort of comparable study in terms of both quality as well as quantitative analysis. Let's talk about another challenge. Some companies, they provide goods and services to same customers over multiple years or multi-period. Okay? Now that poses us the challenge. What happens the customer is not happy for the next year and they might decide to end the contract in the middle. What's going to happen in that case? Let's say the customer, company is losing the customer because they are unhappy. So it's the same situation. Say for example, you are being hired on a contract for a year and for some reason your contract is ended in the middle. So you will have to find alternative strategy to manage your expenses, find some other work or something. So the same way, companies have to find some other customers, but what its implication would be on revenue. Of course, the revenue would be declined. So what company is projecting, the revenue for next quarter may not be there. So in simple sense, what are the various risks associated in that scenario? And how the revenues are broken apart in the balance sheet or in the annual report for multiple periods, multiple years if you're analyzing. You're taking into account last 3-4 years, or you may think about on a quarterly basis too. And is there any forecast involved in accounting? For example, management may forecast that, okay, we're going to be, our estimated revenue for next quarter would be that much. Now, what is the basis of that forecast and how the accounting is making use of those numbers? Another challenge is companies usually face is the creditworthiness of customer. So it simply means that whether the customer to which the firm is providing goods and services, how strong their finances is, or how strong the company is in terms of their cash or assets, okay? Whether they are able to pay towards their goods or services or not. And if not, then what are the strategy firm is going to use in terms of in case of defaults? So there are, it's very similar to, like, say you go to bank and bank has some sort of credit rating for you in order for you to give a credit card. The same way it works for the companies. So different companies, they have different credit ratings, and based on those credit ratings, they are being approved or disapproved for loan and all. And banks usually have a very strong process to deal with the default cases. But what happens if the firm is not a bank, it's just a finance company, whether they do have any strong process to deal with the defaults? or does accounting take into account default risks? So these are important challenges. These questions one should be thinking about while analyzing for revenue. Another challenge is the refund of dissatisfied customers. For example, a firm is manufacturing, electronic gadgets, or let's say any kind of product, and you usually buy products, and those have 30-day return policy, 15-day return policy, and what's on. So, how the company is processes in case of refunds for dissatisfied, you know, customers. For an example, I bought this earbud uh, from Walmart, and they told me that you can return it back within 30 days of purchase. And I said, okay, do I have to uh, return it? As I mean, can I use it for 1 day or 2 days to see how does it work, and return it back after that if I'm not satisfied? So they said, yeah, you can open it up, you can see how does it feel. It's air bed, air mattresses. And I took it home, and I used it, but it was so bad. My back was hurting and I couldn't sleep. So after 2 days, I went to Walmart and I said, guys, this is the receipt, and you need to refund it because it's not working for me. I'm very dissatisfied with this air mattresses. How the advertisement is okay, blah blah, good good good, but it's not really good. And to my surprise, Walmart said, no, we cannot refund because see, in very small print we have um, written that no refunds for air mattresses. And I was horribly upset. I mean, initially they promised me, or the person whom I was chatting at the cash counter, she said, yeah, you can return it back. But they didn't return it. So, see how bad was the customer service at Walmart store in Scarborough, Toronto. Nevertheless, they did not refund it. I had to throw it away, and think what happened. I am no more a customer of that Walmart store, and I'm no more a customer of that air mattresses company. And whoever will ask with me, I will say, don't buy it, don't go there. They have just a bad customer service. So think about it. So they would have refunded money back to me. I would have been satisfied, probably would have bought something else. But there are certain challenges. Now, in the case of companies refunding money to dissatisfied customers with penalty, whether it is being accounted in the balance sheet or not, or what strategy company has to deal with the return risk. Is there any process in place to deal with the defaults, or in this case to deal with the returns? Is there any estimate of returns that, okay, in a year we sell these many items, and how many items we um, customers are dissatisfied and they return back? Is there any such estimate? And if there is such estimate, how those numbers are being used when doing forecasting, or preparing numbers, accounting numbers for quarterly or annual results? All right, guys, I hope you have enjoyed this short discussion on revenue analysis. And thank you for liking and subscribing LeProfessor on YouTube. Those who have not subscribed, please do subscribe. And if you like the video, do not forget to give thumbs up. Next lecture, we're going to be discussing expense analysis. Thank you again and have a wonderful day.